Time for our weekly review where we stick a thermometer up Mr. Market's you-know-what just to check the temperature and see how things are. Because we're risk managers, right? So we're always on the lookout for a crash. Could we just put the back of our hand on Mr. Market's forehead to check his temperature? No. We gotta go deep. Thermometer deep. And you macro nerds are gonna love this video because we do indeed go deep into a few macro topics. And before we get started, as always, if you haven't taken this free training, do it. Link in this video down below in the description and comments. It's gonna teach you the strategy that I use and a bunch of our Fallible members use. It's very simple and very effective. You're definitely gonna wanna check it out, especially because the risk management is on point, the most important thing. Now let's check in with the markets. So this right here is a chart of CapEx trends. And you can see with this blue line, it's pretty much V-bottomed off the CCPV lows and it's back in the positive territory, which is a positive thing for the market. And why do we track CapEx? Well, because one company's spending or their capital expenditures, their investment in their business is another company's profits. So when we look at it from a macro perspective, it's net investment that drives aggregate profits in an economy. And that's according to the Levi-Kalecki equation. And again, this is for those macro nerds. Let's get into it. We'll do the simple version though. So if you pull back and look at the global economy as a whole, it's a closed system. So that means profits aren't magically appearing from anywhere outside of the global economy because, that wouldn't make sense. As we said, one company's CapEx is another company's profits. But these profits obviously aren't a zero-sum game because our total economy grows each year. So if one company earns profits, it doesn't necessarily mean that another company somewhere else has to be operating at a loss. Like I said, wouldn't be any growth if that was the case. So where do these profits come from? That answer is net investment. And net investment is a positive sum game. So if you break down the economy Ray Dalio style into 4 aggregate entities, you have US corporations, households, all levels of US government, and then the rest of the world. So if you look at them all together and how they're spending and their balance sheets, then there needs to be a net positive investment between all of them for there to be profits. So if, for instance, the US government decides to run a budget surplus, meaning shrinking its balance sheet, which just feels like it's unheard of in these times, but which they actually did in the late 90s, then if they shrink their balance sheet and spend less, then either household, corporate, or the rest of the world needs to take up the slack. And they need to expand their balance sheets to make up for that fall in demand. And demand, what are we considering demand here? It's just spending. Budget surplus means less spending. So if these other 3 don't pick up the slack, then demand will fall and profits will contract on the whole. So in the late 90s, US corporations made up for that government's demand deficit by spending more themselves. And by spending more, they expanded their balance sheets because they borrowed too. And then in the 2000s, it was households and the rest of the world, led by China, who borrowed money and invested. US households in homes, which is how we got 2008, and China in building entire ghost cities. Classic China. So the point to understand is that profits are essentially the result of net balance sheet expansion and contraction of the entire global economy. So this is a helpful model to use because we can take a look at those 4 macro aggregates, which again, household, corporate, rest of the world, and the government, and see if net demand or profit is being created. And we can also see their natural limits to how much their balance sheets can expand. If they're already fully expanded and things are teetering on the edge, then that's when the global economy may be headed for a contraction in profits, which is when we get recessions and whatnot. So this is basically a more nuanced framework for understanding how the debt cycle works. It's a more targeted version of Lil Kami Dalio's approach. Profits are essentially the result of expanding balance sheets. That means increases in debt, so more borrowing. And the more these balance sheets expand, the lower interest rates need to drop because there's debt servicing costs, right? There's interest that everyone has to pay on all that stuff that they're borrowing. So that cost needs to be kept down for the marginally profitable firms, which is a lot of firms. That's why we get all this rot in the economy during expansions. Those costs get too high, well then the economy goes into a free fall. Was that a fun explanation? I hope so. But going back to present day, if we look at CapEx, it's expanding again, and that is positive. More profits in the economy. Now on the bearish side, you could see the premium given to US earnings relative to the rest of the world, which is what this chart is right here. The US minus the world PE ratio. It is at levels that have only been seen a few other times over the last 60 years. So normally when that premium gets this high, it doesn't persist for much longer, meaning stocks gotta fall. Now sentiment and positioning is stretched in a few pockets of the market, but not too much. There's still plenty of room for that sentiment to improve before we could say things are exuberant. And of course, you guys remember how sentiment works and how you're supposed to track it in the market. If everybody's super bearish, that's good for the market because that means there's more money on the sideline to come in. If everyone's super bullish and exuberant, that means that they've already put their money in and they're borrowing more money to put it in. So where's the rest of the money going to come from to keep pushing prices higher? So it's a bit counterintuitive in the way that bullish sentiment is actually bad for the market. You want a lot of bears so we could have that wall of worry that we can keep climbing. And you can see right here in this chart on the right, the US sentiment is in blue and Chinese sentiment in black. Things might be getting a little exuberant over in China, but in the US it's still pretty tame. Now another point for our macro nerds, real yields are the fulcrum of global markets. So the falling dollar, rising gold, and the huge trend in growth stocks and momentum stocks all have falling real yields to thank for their moves. But look how low these yields are. The US Treasury 10-year yield hit an all-time record low recently. So is this as good as things can get if this is what's causing returns in the market? Well, Bridgewater, Lil Camidalio, and his friends, they published a paper exploring this question, grappling with the new reality of zero bond yields virtually everywhere. They pointed out that roughly 80% of all global local currency debt now yields below 1%. It's crazy. And in that paper, they explained that managing the monetary base is likely to take the place of interest rate management because, yields can't fall any lower. So just keep pumping money. And Printer Powell is great at that. But that's what they're going to use to fight slower growth and falling inflation. So what we have right now is zero nominal yields, right? Well, how you determine nominal yields is taking real yields and then adding in inflation. But if those nominal yields are held at zero, then they're relatively stable now, which makes an interesting problem because if we're facing a deflationary downturn, meaning we're not getting inflation and it's actually falling, then if we look at that equation and nominal yields stay the same, then what's going to have to make up for lower inflation? Well, real yields are going to have to go up, and that's going to happen as the economy is contracting. And what did we just talk about? We need yields to stay low so that all these companies and all these people can keep paying off their debt. If these real yields explode higher though, that's a huge problem for the economy. So you got to keep them low. So the way to keep them low is if we have successful reflation. So to do that, the central banks will likely delay the rise in nominal yields relative to inflation, forcing those real yields to fall. So they'll focus on the inflation and leave the yields alone. So again, going back to that equation, nominal yield equals real yield plus inflation. Well, if you turn up the inflation side, then the real yield can go down, right? And you can still keep that same nominal yield, which is relatively stable. And there's actually no lower limit to those real yields. So successful reflation can drive them much lower, even if they start at super low levels like they are already. But policy failure, like if we get deflation and they don't print enough, then that's going to drive them higher, and that's how we get screwed. So keep printing Powell. Now this will be bad for the dollar because it's going to get blown up. It's going to be worth a lot less, but it will be good for precious metals. And gold has been on a tear. And if we look at the long-term chart of the inflation adjusted price of gold, it shows that it's still 30% below its 1980 peak and slightly below its 2011 high. So we still got some more room to go. So we're bullish on precious metals and silver in particular, but there are a number of indicators suggesting that both metals are due for a breather. You can see in this chart right here with these red lines that speculative call buying in the main silver ETF hit levels last seen in 2011. And remember, 2011 was the previous high, so that happened to mark the peak. So that could be a bearish sign, at least for the intermediate term, but precious metals markets tend to move like crazy. So this might mean nothing at all. If any of you trade currencies, it's looking like the dollar has hit oversold conditions. So we might get a bounce in the short to intermediate term. And we could tell that by the RSI right here. See how low it is. And you can see right here that semiconductors are seeing their best profit growth relative to the NASDAQ in nearly 3 years. You can see it's a blue line just taking off. And semiconductors kind of lead where the market is going. So this is another bullish sign. And in that space, Intel is really lagging behind. But you can see right here, there's a little red circle where it looks like it's hitting its lower Bollinger Band. So for any short-term traders out there might be an opportunity here to play a short-term rebound, a mean reversion. And right here, we can also look at the number of buy ratings relative to the total is hitting a decade low, meaning analysts are super bearish on Intel. And what do we know about sentiment? When people are overly bearish, there could be something good happening there. So the last time analysts were anywhere close to this bearish on the stock was in 2013, which happened to coincide with a major bullish breakout from a long-term base. Another interesting thing is if we look at FANG stocks. Right now, the put to call ratios have hit an all-time low, lowest on record. And what that means is that there's a lot more people buying calls than puts. And if you're buying a call, you're bullish. If you're buying a put, you're bearish. So that means we're facing the most bullish and the most complacent time ever in this group's history, which again, sentiment, that might not be a good look, which is interesting because I've been getting a lot of emails from Fallible members showing that, they kind of feel that same way. And these are for members that use this strategy that we talk about in this training. Again, link in this video and down below in the description comments. But these guys just started using the strategy and they're trying to build their portfolio for the first time. And the number one question that I get is, hey, AK, there have already been so many profits. Should I just wait here? Like, I don't want to get in and for the market to drop because it looks like it's run up way too much, which I understand why they bring this point up, because we've just crushed it this year. Our model portfolio is up almost 47%, which is way better than the NASDAQ, which is up only 27. So when you're getting returns like this, emotionally, you're going to start thinking, well, hey, is this it? Like, we can't keep going up from here. Can we only move lower? And I completely get it, because I felt the same way so many times before, and it'll happen again. It's just how your emotions work, which is why everyone who uses this strategy, I also give them my psychology course, because more than any strategy or anything in the market, controlling your own psychology and emotions is just way more important, because you could have the easiest, most effective strategy in the world, which I truly believe this fallible strategy is one of those. But even though easy as possible, super effective, you can still screw it up because of how you feel on the inside. And I know, because it happens to me too. And this is one of the best examples when you're up a lot and you don't want to make any more trades because you're afraid. That's when you got to go back and remind yourself, hey, I should really take all my emotions out of this, because I don't know what I'm talking about. No one's able to predict exactly what's going to happen in the market. The only thing we can do is put together a solid strategy or system that we can keep executing, rain or shine. And when I say solid strategy, I mean one that has a positive expected value over a full cycle. So if we know that it does have a positive expected value, meaning if you keep taking trades over the long term, you'll be profitable, then you don't have to worry about what's happening right now in the moment. Why stress about, hey, we're up 47%, will it turn around here? It doesn't matter, because it could turn around or it could go much higher. It's not even something that I think about. So you can see right here, in 2020, we're up 46.44%. In 2018, we were only up about 2%. And there was a lot of swings that year. Go back to 2013, we were up 87.4%. So at some point in 2013, we were sitting at 46.44% and thinking, hey, should I not take any more trades? Well, if you did that, then you would have missed out on so much more. But in 2018, we definitely weren't up 43%, but say we were up 20%. At that point, you could have been thinking, hey, is this as good as it's going to get? Should I stop taking trades? Should I shut down the portfolio for the year? In that case, hey, maybe you would have been right. But how the heck are you supposed to know? How do you know we're not going to get 80% returns this year? How do you know we're not going to get 2% returns? Well, there's a very extremely low chance we get 2% because our risk control is very solid. So we're going to lock in most of these gains. But the point is, you don't know. The only thing you do know is that your strategy has a positive expected value. You know there's a real edge. We're using momentum, and momentum has been around forever, and it will continue to be around forever. That's what you got to fall back on. And you got to fall back on, hey, even though we've had bad years and we had an entire crisis in 2008 and we had another CCPV crisis this year, we're still up over 1900% since 2008. And that's what I talk about when I'm talking full cycle. Bad years, good years, they're going to come. You can't avoid losing trades. It's part of the game. So at the end of the day, you got to fall back on your tested, tried and true strategy. And that's kind of the mentality that I fall back on every time I start feeling my emotions get in the way, which is all the time, because I'm a very conservative person when it comes to money. That's just my personality and my culture, being Indian and all. So we all got our things. Some people want to bet too much and take too many trades. Some want to take too few. But you always got to push that aside and keep executing. And again, we talk about all of that and this strategy in this training. Link in this video down below in the description and comments. And if you like this video and want to see more market reviews, then make sure you subscribe to this channel. We do one every single week. So subscribe, and I'll see you in the next one. Stay fallible out there. Bye.